Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio above the trading floor. Well, earnings season is ramping up, especially when it comes to big banks. They always kick off the earnings season. And among the companies that reported their results this morning, they do include NYSE-listed firms like Bank of America, Citigroup, Goldman Sachs, and State Street. Well, these earnings for the big banks, Bank of America, Goldman Sachs, Citigroup, exceeding expectations, and those stocks reacting accordingly in the pre-market. All of those stocks up several percentage points among the big banks. We had seen stock trading sales and investment banking revenue really driving the results for these big money center banks. Now, even though the biggest banks kick off earnings season, we know regional institutions are also in focus as investors look at the health of the sector and really the broader economy when it comes to factors like loan growth. Well, joining me now is David Chiaverini. He's the managing partner of equity research at Wedbush Securities. David, it's great to have you on the show this morning. And as we see many of these financial companies now start to report, starting with the big banks, how does their performance indicate what we might see for your coverage area?
Yeah, so far so good. And looking at the big banks' results, net interest income has been coming in better than expected. One of the headwinds is on the loan growth front. It's anemic and subdued. We're expecting that to continue. But what's really important here is the outlook. Now that the Fed has pivoted to lower rates, we think that liability-sensitive names are really going to benefit here. It could be a catalyst for improved loan growth. And I'd say probably the most important thing is credit quality. Lower rates is going to help borrower credit quality so that they don't have as many issues that they would have had if rates were higher.
So we had seen the first rate cut by the Fed actually occur at the end of this reporting season, right, in September. And so talk to me more about what might show up in these regional bank results that we will be getting on tap here before we get into deeper rate cuts by the Fed.
Yeah, so for the third quarter, I don't expect the rate cut to really impact the third quarter results, but it should impact the outlooks and the commentary from the banks. And that's where we'll find out, how quickly they'll be able to lower deposit costs, how quickly their loans will reprice lower. And then it's a balancing act, right? Some banks are putting on hedges to protect against lower rates, while others are just naturally asset sensitive and won't put on any protection. So it will be a bit of a mixed bag, but I don't expect the third quarter results to be impacted by the Fed cut.
Noting what you said earlier about borrowers and simply the level of debt that is out there, because we know many Americans have been struggling to get by when it comes to basic essentials and certainly racking up credit card debt along the way. How does the cash reserve system look like for some of these more regional banks that are seeing borrowers with very high credit?
Yeah, there's still a lot of liquidity in the system. When you look at money market funds, we're pushing 7 trillion, and commercial balance sheets are still very healthy. When it comes to the consumer, it's a bit of a tale of two cities. The lower end and lower income consumers, they're the ones who have been struggling more with inflation, whereas the upper end is very healthy. We're talking about how the stock market is at all-time highs. That's generating a lot of wealth. Look at all the home equity that's been built up in homes. So it really is a tale of two cities, but the concentration of wealth at the upper end, that's what's pulling through with the economy. And that's why GDP growth continues to be positive, at least in my view.
And that GDP growth, as you referenced, David, of course, up 3% in the third quarter, I think, defying expectations that we had seen out there. But managing, obviously, the loan growth and what we see, especially when it comes to borrowing costs, any sort of indication from you as to when we might start to see the housing market turn as lower rates are expected to be on the horizon?
Yeah, it's a good question. I would say, listening to our housing analyst, rates would need to get below, say, 4% to really kickstart the housing market. Now, every incremental move lower is going to help. When we saw mortgage rates come down to 6%, we did see a bit of a catalyst on the refi front, but we need to see more rate cuts to really get the housing market going.
So we do see big banks reporting this morning, those stocks higher pre-market. Do you anticipate that we could see a similar equity reaction to the regionals when they start to report?
I think so, especially if the banks are able to communicate the net interest margins, remaining stable in the near term, and then particularly for the liability-sensitive banks, I think they could be in position to really benefit given the outlook for rates.
I'm just curious in terms of some of the events that we see unfolding across the country, how some of these liability institutions, which you're referencing, could be impacted.
Yeah, so the way that they'll benefit is now when rates were going up, it was bad for the liability sensitive banks because their cost of funds were elevated. But now, if the tables have turned, right, with the Fed pivoting, when rates come down, they'll be able to reprice their deposits lower. So that should lead to an expanding net interest margin for those institutions. Now, conversely, the asset sensitive banks that have benefited from rising rates, they're going to see their loans reprice down faster than their deposits, and we could see some net interest margin compression. So we did pivot when we put out our preview a few weeks ago to upgrading some of the liability sensitive banks and downgrading some of the asset sensitive banks.
Interesting, David. Net interest income, just a quick question there. We only have about 20 seconds left. How do you expect that to change for some of these institutions as the Fed lowers rates? Of course, that's the money that these banks make on the loans that they give out.
Yeah, so we're expecting net interest income to kind of stabilize over the next few quarters. When looking at the big banks, for instance, JP Morgan, that reported on Friday, they're talking about a bottoming out on NII mid 2025. I think the liability sensitive banks probably bottom out early 2025. And then the asset sensitive ones are probably going to be under some pressure through the end of next year. However, loan growth could be the offset. If we do see a catalyst of loan growth picking up with lower rates, that could offset some of the pressure that we could see on net interest margins.
David Chiaverini, Managing Partner of Equity Research at Wedbush Securities. David, thank you so much for taking the time this morning.
Thank you.